So I'm turning on the recording at this time. And so everything that we have going forward will be recorded. That way I send out the links to everybody. They're on our YouTube channel. And that way you can get that information and review it and take a look at it. Okay? A couple administrative things. The homework's been coming in great. Procedural-wise, just remind everybody that send in the exercises and the quizzes. Just in a body of an email is fine. I just sent out the answers to Chapter 3 and 4 for those exercises and quizzes, so you can check your work. Look at those. Since we have limited time together online, won't spend a lot of time going through those unless there's actual specific questions on anything. And again, as we're going along, I keep everybody muted. So if you do have questions related to what we're talking about, you can kind of do that over in the chat. You can bring up that chat. It's in the toolbar at the bottom of the screen for the Zoom. As far as the problems from the workbook, just print those to PDF. I'm having those compiled, and then I'll start sending those out before the end of the weekend. You should see Chapter 3 and 4's problems. Just as you turn them in, I'll have them for PDF. We do a couple problems. We were able to fix some logistical things for our in-class. So the videos not only of this one, but my in-classroom on Tuesdays and Fridays, I am recording also. Typically, I'll do different problems than I do with you guys on the weekends. So you'll have plenty of time to see the problems in action, just like we do here with the share screen. So administrative-wise, those are great. So keep those coming. We're going to cover a couple chapters today. We'll be doing Chapter 5 and 6, and then doing a problem each out of 5 and 6, just so you can see some of the things that we discuss. Okay? All right, so we're going to start off with Chapter 5. Let me get... one second here, just having, there we go. All right. Chapter 5. What we're going to start talking about today is refundable credits. This chapter will talk about refundable. I think I brought it up before. The way I remember these credits and the way it was taught to me is refundable credits are the ones that we can consider the Energizer Bunny. What I mean by that, these are the credits that go on and on and on and on. Even after your tax bill's been wiped out, you're still going to receive these credits. So these are refundable that you'll get no matter what. So it's the earned income credit, the additional child tax credit. We'll touch just real briefly on the American Opportunity Credit. That is the college credit, used to be called the Hope Credit. We won't talk much about the excess Social Security nor the undistributed capital gains. And we'll talk a little bit to distinguish the differences between the health coverage tax credit and the insurance premium credit. Okay? So, as we talked about here, these are the objectives we're going to go through. The premium tax credit, we'll discuss that a lot more later on in Chapter 16. For right now, just to keep from confusing you, there's a lot of information I'll be able to convey to you. I'm actually a health insurance navigator for the marketplace in the Affordable Care Act and a Medicare person. So I'll shed a lot of light on that. But for right now, we're not going to get real deep into it. So just in the problems, we're just having you check that they're not in the marketplace, that they don't need an exemption, and then that first box after their name that they were insured all 12 months. So we're just going to kind of go through there. Okay? All right. We're going to start off with the earned income credit. This is probably one of the biggest credits as far as monetary value that shows up on a tax return, especially for middle to lower income families. So it's a very important credit, but it is also the credit that has the most fraud as far as the IRS's eyes. For your reading, you probably heard all the stuff that's in there. when it talks about the things that the penalties for a tax preparer or somebody that is doing their taxes has this credit on there and does not follow the rules. Very specific rules. These rules are not gray, they're very black and white. So just make sure that you understand what these rules are and how people qualify for this credit. But the way the earned income credit works is it starts at zero, kind of slopes up, reaches a plateau for anybody between about 14 and 23,000, depending on their filing status and their family size, up to 3 kids. And then after that, after it's maxed out on that plateau, it drops off pretty sharply. We'll have a table that'll kind of show when that falls off. But it's a credit that is very beneficial to those middle, low-income families that have this credit. Okay. Great little table here. Kind of talks about all the different credits that are in there. We had a question about if somebody tax-wise automatically determines if the client is eligible. Yes, it does. What that does is when we do the main info sheet, there's that column that will put the child's name in there. When we go to do a problem, we'll talk about that, but you automatically check that and it will calculate it based on the family's filing status and the family structure and the number of qualifying children that would be on the return. So when we do the problems, we'll kind of talk more about it and get real specific as to how that calculates that. As far as the income, this kind of shows the rules for everybody. First thing you got to do is meet the certain rules as far as income, so to see that you qualify. Then you must meet the second rule, talks about qualifying child. And then you must meet the third one, that you do the earned income credit and claim it on your taxes in a correct manner. And as a tax preparer, we will do our due diligence, as we will talk about. Okay. As it talks about on here, to qualify for it, you must have earned income. Remember chapters 3 and 4, we talked about what earned income is and what unearned income is. You have to have earned income, as it says in parentheses, be working. The rules for everyone are the same with or without a qualifying child. We talked about the adjusted gross income. You can see those. You can have, must have a social security number. You're married. Your filing status cannot be married filing separately. This is just the tip of the iceberg as far as married filing separately. As we go along, we'll see a lot of credits that once you decide to do that filing status, there are a lot of credits that are taken off the table that you're not eligible for. Okay. Must be a U.S. citizen. Cannot file a Form 2555. We'll talk a little bit about that later again. As it says there, that is foreign earned income. So if you have somebody for us in Buffalo that is a Canadian, has earned income over there, then they cannot be eligible for that if they're filing that Form 2555. And you must not have investment income. Your investment income must be $3,400 or less. One time this comes up a lot for people that you have to explain to them. To elaborate a little bit, if I have somebody that is making $18,000 and is a single mom, had a household, 2 children, but she lives in a double. So half of it she lives in, the other half she rents. That income from that investment, that rent that she has, if her net profit on her rental is more than $3,400, she will not qualify for the earned income credit. And then as it says at box 7, must have earned income. Okay. To take it a step farther with the qualifying child, okay, and if you don't have a qualifying child, these are those tests that we met for somebody to be on a return. You have to pass that relationship, that age, that residency test. Due diligence, when I talk about that, I'll talk about the things that are very important there. If you're not a qualifying child, or if you do not have a qualifying child, you must be at least 25, but nobody over 65 can receive the credits. You cannot be the qualifying child of another person. What that means is if we have a college-age student that is a dependent on our return, but also files and works a summer job to help pay for college and makes the income threshold that may make them eligible for the earned income credit, they do not get it because they are being claimed on somebody else's return. So even though their income might qualify them, they do not get the earned income credit. Okay? I have some examples here that we talk about that you can kind of read through. We'll talk a little bit more on the problems, but this is a very good one. We have here John and Janet with their daughter Amy. They have some adjusted gross income all earned of $11,000. So that we do everything that we have here. We complete the earned income credit. And this first worksheet that is from the earned income credit, you can see for the qualifying child, each one of those sections is all the questions that we talk about. The child's name, have to have a social security number. They have to meet the age criteria by their age of birth, their relationship, their residency. Did they live with you in the United States? Okay. Again, all these things are those tests that they were just talking about. All right. Second example is a young lady that is single, age 30, is a full-time student. She lived with her parents, but she's not claimed on theirs, so that she does have a very modest earned income credit that she would have. All right. As I talked about, this is one of the biggest areas of fraud. The IRS each year has cracked down on this more and more and more. They make us as tax preparers do our due diligence. So what that means is we have a very stringent set of rules and a form that we'll talk about, 8867, that we have to fill out. But these are the consequences if somebody chooses not to follow those and, again, goes after this as a tax preparer. You know, we're looking at a $500 penalty for each you and your employer. You know, could be $1,000. Obviously, too, it talks about could be subject to criminal prosecution. So all very, very rigorous rules that, you know, would be consequences for not following this. So always make sure that you do your due diligence on that, okay? This is the form. Each year this becomes more and more. If you take a look here on these now that we have up here at the top, all right, we've added 3 columns. These are all refundable credits that we're talking about. The EIC that we're talking about right now for the earned income credit, the children on there, there's a part of that, the additional child tax credit, the ACTC, a refundable credit, and the American Opportunity Credit, another refundable credit. So again, these are credits that people get basically, even if they do not have a tax bill, they could be eligible for these. So this is areas that the IRS feels that there is the most fraud. So this due diligence form is done for us to meet the criteria on these. Okay. Okay, and we'll see these in action a little bit more in the problems. Okay. Documents. This is where I was talking about the due diligence. If you take a look at the one section of the EIC here, we have a section that talks about the due diligence and the retention of records. We have scanners in all of our offices so that we can get this information and retain it. You know, most of my clients, they pretty much understand that each year I'm going to ask them for this and I need to see this just because I have to do my due diligence. I can't compromise my credentials or Esther Goulis's tax service. I don't want to compromise Esther's credentials or reputation by doing anything that we shouldn't. So there's a list here that we're going to talk about of documents that you need for the earned income credit. These things are all very good. School records are not as good as they used to be. The days of somebody bringing home or having a report card for their somebody in school, high school age or less, being mailed home doesn't really exist. Most of us now have to go on to a portal through our school and you know, get that. That being said, a lot of times the parent's name and the parent's address is not on the statement. So you would have to get a statement from the school on the school's letterhead signed by the principal saying, this child is a child of these parents that live at this address, and that's what they have for record. Leases, if somebody's living with somebody else as a child, it's probably listed on the lease, and you can bring that in. Healthcare provider records or medical records are very good. Usually have the parent's name, especially if there's a minor involved. Child care records, if there's somebody that takes care of your child. Social services records, when we're talking low income, if it's somebody that's qualifying for SNAP, public assistance, Medicaid, those records are very good because a lot of times it's the same names that are on that as are on the tax return for the earned income credit. Okay, so those are all good ones. But again, part of the due diligence, you must make sure that you are retaining those records and asking them for all those things. Okay, some examples here. They're very good. Just these you should see when you ask additional questions to meet your due diligence knowledge requirements. Okay, I always tell everybody, I go the extra mile. And usually when I talk to somebody, I am not trying to interrogate them or do not trust them. It's just that I make sure up front that they understand that myself as being a credible, reputable tax preparer have to ask these questions per my credentials. So I will ask them these questions, and they're all very good about it. In the years I've been in taxes and the thousands that I've had, I think I've had 2 people walk out because they weren't comfortable, and I don't think that I was kind of comfortable either, because I don't think their information was legitimate for their claim for the earned income credit. Okay. The 8862 is a form that happens very rarely. Should somebody be disallowed from taking the earned income credit, typically it's about 10 years they cannot take the credit and a $10,000 fine. So if you think about that, somebody that's starting school, 5 or 6 years old, 10 years, that credit would not be able to be used for that child that's probably could have you get the earned income credit until they're almost graduating from high school. So, it's a very good credit. There are ways if something's disallowed. Sometimes we use this form if somebody's been disallowed because what happens in certain situations where there's 2 parents living separately for a child, both parents may be eligible for the earned income credit. Sometimes it becomes a race to the finish line. Who can file first? Again, we have to do our due diligence. If somebody's denied, we can send their return in paper if they have proof that the child lived with them and all the records that we would have to show so that we can fight it because the other person, we may see a divorce decree that shows us that the other person that tried to claim is not the custodial residential parent. So these are things that we will try to pursue. All right. Again, the exercises, go through those. Be sending out the answers on those so that you can go through those. If there's any of them that come up that everybody's having a sticking point on, I typically will go in and we'll talk about them from the answers that are sent to me. A lot of these are just, again, paper exercises because we want you to see the forms in motion. The software is very good. It calculates for us, but it's always nice to have people do the paper so that if they have to explain or understand better how the numbers are calculated and who's eligible, that we need to make sure that they understand that. Okay. Okay. The additional child tax credit. This is a credit. For those that have kids, I guess the IRS has decided that you can get $1,000 to raise every one of your children. Okay, that's all you need per year is $1,000. Okay, but it is a credit that is part non-refundable and it can be refundable. What that means is this credit would be used up to the point of eating up your tax bill and then refundable, or it could be all used as non-refundable to eat up your tax bill. Okay. The remainder will go down to a lower part of the 1040 and then you would get it. So you're going to get that $1,000 per qualifying child, whether you have tax due, tax liability or not. Okay. We do this form in the 8812. Again, very similar. We saw the due diligence form on the 8867. So if there's an additional child tax credit, we may have to complete that. But again, a lot of due diligence that we have to do. They have to meet all the criteria, all the tests of a qualifying child so that they can be on the return and be eligible for this credit. Like I said, touching on the American Opportunity Credit real briefly. As you're from your reading, Chapter 6, we're really going to go in depth to it with the American Opportunity and its sister, the Lifetime Learning Credit. But here, this is a refundable portion. As it says, up to 40% can be refundable. So even for somebody that is not claimed on the parent's return, they are working, may not have a tax bill, but they are in college and do have qualified education expenses. They can take this credit and be able to use it, and get $1,000, 40% of the $2,500 total. Again, when we go into Chapter 6, we'll talk a lot more about it because it really starts out in the non-refundable section. Okay. As I talked about, not a lot of things that we're going to talk about for the credit for the excess Social Security tax or railroad tax. I do have, and I'll make a note again to email out to everybody, I have a W-2 I'll send out to everybody that shows the railroad W-2. It is set up a little bit different so that we have that. And I will also send out a PDF for everybody. I think I talked about with unearned income for brokerage accounts and how those look, okay? I had created one and passed it out yesterday in my class. My classroom classes on Fridays, and so I'll send out to everybody so you can kind of see some of the other formats that you might see for interest and dividends, and then a alternative format that we may not typically see in our problems that you can have kind of for your reference as far as how somebody that works for a railroad has their W-2 handled. Okay. Again, credit for tax on undistributed capital gains. You just don't see this one. It's in there for reference because it is part of the 1040 and is listed there. Read it. I don't think I did any last year because of the way that everybody's brokerage accounts work. So again, just a point of reference within the textbook because of what's in there. Okay. The health coverage tax credit. Okay. Again, this is much different than when you hear about the health care tax credit or the subsidy or whatever it may be. The Affordable Care Act through your state, so government marketplace, that is set up to give you a monthly credit towards your health insurance to help you afford health insurance. Okay, this one has been around for a while. It's called the Health Coverage Tax Act. Where we see it most often is the auto industry when it was during the bailout. People that were retired. Part of the bailout agreement that took place is that anybody that worked for them that had health insurance they were paying for, they could go back and they could file this to get a credit towards the health insurance, okay, for the months that apply. The other thing that we see it most often is for somebody that has been displaced, as they say, okay? What I mean about that is that if we have somebody that is again, near where we're at, the auto industry, somebody was a specifically highly trained position that when the factory closed, their job was shipped overseas. They would be eligible for this credit for the time while they were being retrained to be put back into the labor force because their skill set was specific. They would be able to get this credit to help pay for their health insurance. Okay. We see the form here. Again, very specific, similar to what we see with the Affordable Care Act. This form is 8885. You can see here that there are month boxes that we have that are down here at the bottom. These, they'll get a form, 1099, they'll get a form that has the months that they're eligible for it. If it's a retiree, they might all be checked, okay? If it is somebody that's being retrained, maybe just the time that they were out of work being retrained, those would be the months, okay? All right, there was rules. It talks about there to be able to take this credit. A lot of people were not aware of this credit. We had to do some amendments for a couple years going back because of what happened with the auto industry, but it's a credit that exists, okay? All right, so there's chapter 5, okay? Like I said, we're going to do a couple problems together at the end. We'll get ready for chapter 6 here in a second, but if anybody has any questions, just let me know. If you want to turn your, you can do your verbally or type it in the chat, anything that we covered in that section. Okay. All right. Okay. No questions. Great. Okay. Again, you know, as we're going along, if you got questions, type them in the chat there. I'll address them, or you know, tell you when we'll get to it. We'll kind of maybe bundle them together. If anything comes up, just make sure on the microphone you can turn that off and pop on there also. Okay. All right. Now, this chapter, we're going to talk about non-refundable credits. Okay. Again, I brought up the point that when we talked about the refundable credits, those are the Energizer Bunny. They go on and on and on, no matter if you have a tax bill or not. Okay. We refer to these as the Pac-Man credits. Okay. What I mean by that, for those of you that are old enough to remember Pac-Man, I actually had a discussion with my kids the other day about Pong. They couldn't believe that that was what we did for video game entertainment. But as far as the Pac-Man credits, it will eat and eat, just like it does in the game, and eat the little dots until they're all gone, and then it's done. Exactly what a non-refundable credit does. It eats up your tax bill, and when it's ate up the entire tax bill, it's it. It's done. Okay, you don't get the remainder of the credit that it's calculated. It stops when the tax bill is gone. Okay. So we're going to talk here in this chapter. We'll talk about the difference between a deduction and a credit. A very good thing to understand, because a lot of people don't really understand the difference between the two and how it impacts their taxes. We're going to talk about a little bit more of a difference between non-refundable and refundable, because we'll have knowledge of both. Foreign income credit, we're going to talk about that, or excuse me, foreign tax credit, we'll talk about that. Child independent care credit, if you have a child that's in daycare or even a dependent, as it says there. We're going to talk about the American Opportunity and Lifetime Learning Credit, both the college credits, whether we'll talk about the undergraduate and graduate school applications, and then how we get these credits on the return, okay? Realize this chapter from reading it, it wasn't the most exciting chapter to read. It is a long chapter, but there's a lot of redundant stuff, especially with the education. We're going to try to slim it down a little bit, so we'll have some time to do problems and things like that, so we'll slim it down best we can, okay? All right, tax deduction versus a tax credit, okay? If you remember during the elections, this is where you kind of tended to hear this a lot more than others. We had, they always talk about when somebody pays taxes, how much did they pay based on their income? I'm going to use this little table here. And what was their tax bracket versus their effective tax rate, okay? I can remember most vividly when Mitt Romney was running for president, a very wealthy man, and they kept talking about his effective tax rate, saying, look, he has income, he should be in this tax bracket, but he's only paying this rate. Well, you know, made it sound out like he was cheating, okay? He's not. You're just using the tax law the way it's set up and the way we're going to teach you to use it to minimize tax rates and maximize the refund. But the effective tax rate, basically what that is after you take your deductions or your credits, what you're really paying on tax, okay? So, you know, this table shows the difference between the two with their effective rate that they have on there, okay? All right. Okay. And we can talk about deductions versus credits when we get into our effective rate too, okay? A deduction, all right, is going to lower our taxable income, all right? You can see in the table below, a deduction is going to lower the taxable income, all right? A credit eats up the tax. So one way to think about it is a lot of times people will come in and say, oh, almost the end of the year, I gave $5,000 to the church, okay? Well, that's great. When we do their taxes, they see their tax refund and they say, well, where's the $5,000 that I gave to the church? I'm supposed to get that back on my taxes. Well, it doesn't work that way. That's part of itemized deductions. So you're deducting from your taxable income, or excuse me, your gross income, and you're lowering your taxable income, okay? So it is a dollar for dollar reducing your taxable income, but it is not dollar for dollar reducing your tax bill, okay? Not what a credit would do, all right? So that's where those differences can come in, all right? As you can see here, a tax deduction saves only a percentage of the deduction amount, all right? What I mean by that is that it's not taking off your tax, it's just showing that it's going to lower the percentage, the tax bill as a percentage of your income, okay? Now we're going to consider the tax credit, okay? So we can see here are two examples, and then the tax credit reduces the tax due, okay? So instead of taking these things as a deduction, we see their effective rate. Here we see no tax deduction, all right? But we do see over here tax credits, okay? So that's going to lower their tax paid. So you can see that there's more benefit to the credit as far as lowering their tax because it becomes off dollar for dollar off their tax bill, okay? The deduction is not necessarily going to go dollar for dollar off their tax bill, all right? So their taxes are not lowered dollar for that money that they give to the church, all right? Okay. All right, as we talked about non-refundable versus refundable, non-refundable, that the tax credit is more than if the tax credit is more than the total tax due, the tax is reduced to zero, but no excess. You basically lose out on that credit, okay? Refundable credit, Energizer Bunny, okay? Even after we maybe used it in the section to reduce our tax, we're still going to get it. So if we don't owe any tax, we're still going to get this money, this credit back. Okay? All right. Foreign tax credit. The foreign tax credit is a credit that most often we see for calculation purposes on the Form 1116 is if it's somebody that maybe has earned income in a foreign country. I have several clients that are from outside the United States. I had somebody back a couple weeks back that lives and works in England, but is still a U.S. citizen. In fact, they have dual citizenship. Because of that, their income comes from England, and they do tax over there, okay, and pay very high tax. So when I go to do his tax return, I put his earned income in a foreign country as a U.S. citizen, so that would possibly create a tax bill. But because he paid tax in that foreign country, he gets a credit. It is a non-refundable credit that would wipe out his tax bill in the United States because he's already paid tax on this money. Basically, treaties exist between a couple countries so that they don't, your money's not taxed twice, okay? What we see most often when we do a tax return is that there'll be foreign tax. Again, the brokerage statement that I'm going to scan an email out to everybody. You'll see in there for dividends and interest, if you have a mutual fund or retirement fund that has foreign holdings, sometimes your stocks may have paid tax in a foreign country. Well, because you paid tax on that money in a foreign country, you get it as a credit on your tax return. All right? And we'll talk about, and I'll show you where we put that in. All right. The Child Independent Care Credit, okay? Very good credit. Again, it is a credit and a non-refundable credit that helps eat up the tax bill, okay? It is not a credit that is really dollar for dollar for what you pay in daycare. And I know from seeing families doing returns, I am just thankful my kids are the age that they are. My son that has my grandson, you know, it's a decision for them as far as their child care. It's very expensive. I hear families paying in the upwards of $400 to $500 a week. So that adds up through a year. Well, when they come in and they turn that into me, that they want to take the credit for their child care expenses, again, not a dollar for dollar credit that for every dollar they spend is it going to reduce their tax bill, okay? The credit can be used up to 35% of those expenses, depending on the adjusted gross income. All right, so there's a cap. We'll see on the form when we do show the 2441, we'll see how that works. But it is not a dollar for dollar credit. Like the individuals that talk to me about their contributions to the church, they think when they do this that they're going to get a dollar for dollar back on their refund. Or for somebody that has gambling losses. These are not the case. It will proportionally or percentage of impact their taxes. Okay. The other thing too is, you know, you have to do a little due diligence on the dependent care and who they're paying the money to. I will have people come in and say, hey, I paid, you know, grandma and grandpa, you know, $500 a month to watch my kids while I work. Okay, that's great. And they want to claim that they pay for child care. But I have to inform them. You paid $500. Are you going to have give grandma and grandpa a 1099 because they'll have to declare it as income? You know, it can't be one side of the equation. If somebody's claiming it as an expense, somebody else has got to claim it as income. Okay? So, that being said, you know, somebody has their sister watching, and very often they'll say, I just never mind. Okay? Well, by right, we should tell them, yes, you can claim it, and that other person should be claiming that as income if that is their employment and it is greater than $600. But again, you know, most people that's the case, and they'll turn around and say, no, I just, you know, give her a little bit of money to pay for groceries or buy the groceries or whatever. So, okay. It must be a facility that meets the criteria. Most facilities that you have, you know, they know that at the end of the year they're going to need to give a statement to somebody with their EIN number and their facility's name and address and who they watched and how much they received from the person so that they can bring that in for us to be able to calculate. Great little flow chart here. Okay, and remember, this is not just a child tax credit. Okay, this is also the care of a qualifying person. What I mean by that is must be mainly for their well-being and protection. You know, I have clients that the situation is that mom lives with them, both of them work, and there's nobody at home to watch mom. Well, you know, nursing homes or visiting nurses are very expensive, so they've taken it upon themselves to allow that person to live with them. And so to keep their costs down, they may have them in an adult daycare situation so that they have somebody that can take care of them for their well-being and protection. Okay. Also, single parents. A lot of times after school, the kids may be in something that is for them to be able to be somewhere safe while they're still working and outside school hours. You know, those things do qualify. Okay. After school programs of soccer or football or whatever, those don't qualify. Okay. Those are more entertainment. They're not necessarily something that is for the well-being and the protection of the child. Those are more for the entertainment that they're participating in. So you just got to make sure that it's really a situation where that person is being taken care of you know, in an after-school program or an adult daycare program. Okay. Again, the credit is going to go on our 2441 form. Okay. The other thing too is, remember when we did the W-2s, that box 10 talked about the dependent care. I always use the example of Geico. There's a lot of times that Geico has benefits that they pay to their employees to help them cover the cost, especially single parents, to cover the cost of child care, or they might even have a child care facility right in the building that they just have them, you know, help them pay for that. Okay, so we have that. You got to reduce it dollar for dollar. Also, if somebody has a situation where maybe they have public assistance, that they're getting money so that they can go to college or be retrained or get a job or start a new job, and they have somebody that is one of the children is going to be watched, and they get some money from the state, we have to take that into account. Okay. Here's the 2441. Again, talked about the fact that up here at the top, we have to list everything that is on the little form that they may get. We see within the box here, it has the care provider's name, the address, identifying number. Again, some people just do this out of their home, so maybe a social security number. As I talked about a relative, you're going to claim it, then guess what? You better give me the social security number, because I'm giving it to the IRS, and the IRS is going to be looking for that other person for their income, because that's been reported to them. So we have to make sure that we know that if we're taking as an expense, if it's a relative, that the relative better be prepared to pay tax on it as income. Okay. All right. Okay. In the middle part of the table here, we were talking about the limitations. It can be up to 35%. It is based on a family's adjusted gross income, okay, as far as to what they qualify for. But you can see in here, it says it entered as a decimal amount, but that's that 35%. Can drop as low as 20%, and that's as low as it's going to go, okay? So we have that there. Also, you can see that this is a non-refundable credit. So chances are this credit could be, you know, $600, but only $600 can be used of the amount that was paid, okay? Equally, once the tax liability is eaten up, if you didn't use all $600, then the rest of it's lost, okay? So you have to make sure that they understand that, not a dollar for dollar amount, okay? All right. Employment taxes for household employees. Again, read through this. We do not see this often. Most of the, I used to have a few clients that I did returns for that were nannies or au pairs from foreign countries. It was actually through an international au pair firm out of Colorado that I had. They knew exactly how things were to be within that parameter and not, you know, fall in this category as far as what they paid them and how they structured it. But just make sure that you're knowledgeable of this, so that if that income does show that they need to file, then they'll need to file so that they can pay the self-employment tax. Okay. Education credits. As I talked about when we were looking at our due diligence form for the earned income credit, this is the other big credit on a return. Basically, that earned income credit is in place, you know, through somebody's, you know, 24th birthday, if they're still in college. And then over and above that, there's an education credit for somebody, especially the refundable portion of the one that is on the American Opportunity for Undergraduate Studies. Okay. Lifetime learning is a credit that exists. It is non-refundable, so again, only eats up the tax bill, then it stops. But it may be for somebody that is in graduate school. Okay, great little table here that basically has the rest of the pages kind of in a summary. We're going to go into more specific details as we go along and touch on some of them. But you can see in the first column, the American Opportunity Credit. First thing to always remember, American Opportunity Credit is available for each eligible student, okay? So if I have 2 undergraduate students on my tax return, all right, they meet the age and they're an undergraduate and they meet the eligibility, I can get the $2,500 credit for both of them, okay? If I have 2 students that still live at home that are in grad school, all right, so I have 2 dependents on my return, then it can only go up to $2,000 per return, even though I have 2 students, okay? So that's where the difference is. Next one is, we'll start to talk about this more, but it's called the phase-out categories, okay? What that means is as your income, depending on your filing status, gets to a certain level, these credits begin to phase out, okay? What I mean by that with the limit unmodified, I always tell everybody, I want you to think back to the movie Back to the Future. Michael J. Fox holding in his hand the picture of his siblings, okay? As the movie goes along, you see them start to fade away, all right? Want that image to have when they talk about a phase out, same thing. The children or dependents or credits that are attached to them just kind of start to fade away until they reach a maximum level that you see here, okay? We talked already, American Opportunity has a refundable and non-refundable portion. Lifetime Learning, strictly non-refundable, only eats up the tax bill, okay? American Opportunity, because it is a very good credit, is only available for the first 4 years of post-secondary education, okay? All right, so it's available only for 4 years per eligible student, all right? The Lifetime Learning, no limit on the number of tax years that you can claim this, okay? What that means, if you have an undergraduate, first 4 years you can get the credit. If they spend the next 8 years to become a doctor and they're still living at home, maybe they're eligible for Lifetime Learning. They could do it for up to 8 years, okay? All right, so we have that. Also, I always have people ask me, well, do they need to be a full-time student? No, the way that it reads is they must be enrolled half-time, okay? What I mean by that is that's up to the institution. It doesn't mean that it's necessarily 6 credit hours or 7 or 8. It's based on the institution. If somebody's a full-time student at that institution at 12 credit hours, then they only need to be in 6. It'll be checked on the little 1098T that we'll talk about later, okay? The other thing that we have is the felony drug conviction. This is something that was new and added a few years back, but as of the end of the tax year, the person cannot be convicted of the felony possession or distribution of a controlled substance, okay? Lifetime Learning, no such question on our due diligence, all right? Now, I'm going to give you an example on this one. It was an interesting example that happened to one of my clients that I had in. She did not come back the next year, but she came in, a single young lady, college age, undergraduate. She was there with her friend who sat there and just, you know, she didn't mind that she was in there. I had asked if it was all right if she sat in, and she wasn't saying a word. She's typing away on her phone, doing whatever, updating her Facebook status. Didn't say a peep. We're going through. The young lady that I was preparing the taxes for handed me a 1098T for her education. She qualified for the American Opportunity, was going through the due diligence, and I asked the first question. Have you ever been convicted of the felony for possession or distribution of a controlled substance? She says no. I said, okay. Her friend, who had not said a word, again been on her phone, turned and looked at her and says, well, what about last year when you got pulled over with so-and-so in the car and you guys were convicted for the possession in the car? The other girl looked at her, grabbed all of her documents off the table, and walked out. So obviously her friend kind of threw her under the bus. You know, no pun intended about a school bus, but you know, those are the things. If you're doing your due diligence, you know, it's hard to know. But once you collected that information, there was no way that you'd be able to proceed with that tax return. Qualified expenses, we're going to go into that a little bit later too. Okay. As far as the 8863, that is the form. You must do that form. We can find it right there on line 50 of the tax return. Again, we'll be doing that when we go into the problems and the examples that we're going to do, okay? Now, generally a taxpayer can claim either the American Opportunity Credit or Lifetime Learning if 3 of the following requirements are met. The taxpayer paid qualified and this term qualified you're going to hear. We heard qualifying child already. Now we have qualified education. We're going to hear about qualified retirement. It's a term that basically is saying that there's a test. The IRS has a test, or there's criteria to meet in order to be qualified for these. Okay. Higher education expenses. The education expenses were paid for an eligible student, and the eligible student is the taxpayer, spouse, or dependent for whom the taxpayer claims the exemption, or the credit, I'm sorry. Okay. Also, they must be at an eligible education institution. All right. If somebody is issuing a 1098-T, nope, room and board is not included. We're going to talk about that, but room and board is not included in qualified education expenses. Okay. Basically, a eligible educational institution is basically anyone that issues a 1098-T. What I mean by that is we have in the Buffalo area, there's some cosmetology schools. Well, people think, that doesn't, but they're not inexpensive to go to anymore. People can go do a FAFSA for student aid. A lot of those schools now have taken it and they've really done a nice job where they do business classes so that that individual knows all the ins and outs of keeping their expenses and their profits and making a successful business. So those could be higher education or eligible education institutions. It doesn't have to be a ECC or a four-year college or whatever it may be. There are places out there that are eligible educational institutions, even some of the online, okay? So we have to make sure that we're aware of that, all right? Okay. All right, as far as the expenses paid, okay, this is one too that everybody gets a little bit unsure of. Expenses paid, as somebody just asked, they are not room and board, okay? They are qualified. They're tuition, all right? They're supplies. What I mean by that, if I have somebody that's attending ECC and they're an art student, well, if they're having to buy brushes and paint, then that's qualified educational expenses. If they're a doctor, they have to buy a stethoscope. They're going to medical school. That's qualified education expenses, okay? It has to be in their course of study or their major course of study, all right? We would be hard-pressed if our art student decided to take a auto mechanic class as an elective, not a requirement, but elective, and she wants to write off all the tools that she bought to repair her car. Well, we'd have to really look at it and see if that's not a stretch, okay? All right. One second here. Somebody's text on something. Okay. And we had a question here. Question, how union dues and apprentice education. Again, those type of things, if it's not a requirement as far as an eligible educational institution, they're probably not going to qualify for the American Opportunity. Lifetime learning, again, it'd be a stretch when you're talking about apprentice programs. Most of those would probably fall under the expenses on a 2106, which is employment expenses, okay? These are more that you have to be at an eligible educational institution, all right? Now, as far as where the money comes from, all right? If the expenses are paid by the dependent, they can do that. If they're paid by the taxpayer, they can do that, or a third party. What that means is even if grandma or grandpa pay for it and they're not on the tax return, that money is considered to be given to the child and then paid to the institution, all right? Now, most people have financial aid. The cost of higher education is a lot now, so we have to have ways to pay for it. And as you hear in the news, student loans, they have surpassed credit card debt and are trailing very close behind mortgages as far as the debt most people have, okay? If I have a school and I'm paying $10,000 a semester to go there, and I have $7,500 of scholarship, then the remaining $2,500 I've taken out a student loan. It may be a student loan that I'm not going to pay back until after I graduate. Well, even that student loan is considered expenses paid at that time. It's as if the money had been paid by that student for the claim of that credit at the time, okay? Just because we're not going to pay for it really until later, it's a loan to us, we can still use that for the qualified expenses, okay? Who can't claim an education credit? Again, you know, the taxpayer or their spouse are filing jointly is claimed as a dependent on somebody else's, okay? Because that credit follows where that dependent is. And here's another one. Taxpayers filing status is married filing separate. $2,500 credit, a lot of money left on the table because we're doing a separate return, okay? And also it talks about the phase out with $180,000 for a family. So that would be something on that, okay? Again, the American Opportunity is eligible for each student, all right? Qualified expenses, we talked about that. All right. As far as adjusted qualified education expenses, any money that you receive that is tax-free, okay? You know, scholarships, Pell Grants, TAP in New York, the GI Bill, anything that is basically coming to you that you are not going to have to pay back, then those or things from 529, some of the QPTs, qualified tuition plans, some of those things, you know, those are not something that we can put towards the qualified education expenses, okay? We have to reduce those, and we'll see that when we do a 1098-T, all right? All right, and just remember too, it talks a little bit about here, if we have excess money from our scholarship, and that's issued in a check back to somebody, if it's a scholarship, again, not loan, but if it's a scholarship, then we have to declare that as income because we basically are getting that money tax-free. We're not paying interest on it. It's not part of the money that we have to pay, okay? All right. Okay, we talked about American Opportunity. Again, we talked about the academic period. They must be enrolled at least half-time in the first 4 years of post-secondary. So if somebody goes 2 years to community college and then goes somewhere else for 4 years to get a bachelor's, well, the first 2 years at that other school, they can still take the American Opportunity. It doesn't be limited to a school, but it's just the 4 years. One thing I want everybody to remember too, sometimes a college will fall into 5 tax years. What I mean by that is somebody graduates from high school, the first tax year is the fall of their freshman year, and the last tax year may be a spring in the 5th tax year. You only get it in 4. And typically what happens, you don't worry about the 5th year because with most universities, that spring semester is billed before the end of a calendar year. So those scholarships and loans come in, the tuition is billed. So really, that first year, their fall, their freshman year, they're really getting billed for 2 semesters, and it's rolled into that first year that they start college. So that's the first year you can take that American Opportunity credit. All right. Again, we talked about the felony considerations there. Okay. All right. And there's a refundable portions calculated. All right. The 1098-T. Okay. The infamous 1098-T. Not a big fan of these. Most of the colleges do not fill them out correctly. All right. Most of the time, we will see that they have the amount listed in box 2, not in box 1. Box 2 has amounts billed for qualified tuition-related expenses. Okay. Box 1 is where it actually shows what was paid, and then box 5 shows scholarships and grants. Okay. Box number 8 for us has on there that it shows that it was at least time student. And then box 9 is the other one we see most often because it's checked if it's a graduate student. Okay. All right. Now, One thing I want you to note here is when it talks about box 5, it says it shows the total of all scholarships or grants received by the person on behalf of the student. These amounts must be subtracted from the amount in box 1. Again, you know, that box 1 shows that all the things that were paid, okay? So box 1 shows that payments received, whether it be, you know, cash, check, Visa, credit card, student loans, scholarships, that's the money they receive for the students. Well, it's saying in box 5 that there was a portion of this that was tax-free, scholarships or grants. So we can only use for qualified education payments the amount that is over and above our scholarships. And again, if that amount of scholarships exceeds box 1, then we may have an instance where we have to do some things for that is income. All right. Here's an example of a completed 1098-T. It shows the payments received. Okay. For my student, or excuse me, for my clients, for their students, I will most often have them go to the student portal and print out a statement of student account. On the student portal where they see the grades and sign up for classes and everything, they can go in there and print out what looks like a bank statement. It shows line by line what fees were billed and what they were for. So I know that student insurance or transportation fee or a room and board or whatever that may be, I know that I can't have that part of it. So I make sure that that number in box 1 is correct. But I'll see their tuition bill and any fees that pertain to their major. And then I can also see there how it was paid. Did it come from student loans? Did it come from grants, scholarships? Or was it paid by a check from somebody? Okay? So I can see right on there, and it gives me more detail. It tells the entire story. 1098-T doesn't always tell the entire story. Okay? All right. Here's our 8863. This is page 1 of the 8863. You don't see it, you know, I want you to know how the calculation works. There's some exercises to go through this. Make sure you understand how that calculation works, how then you can do the refundable and non-refundable portion. All right. Most of the time what we do is the stuff that is on page 2, okay? We have to enter the student's name. We have to enter the social security number. The reason it's on this form, I have to show who I enter is a dependent that I've listed already on the return. We've got to show them that there's an educational institution that we know exists as a eligible one. There's 2 boxes because obviously somebody could have transferred in the school year. We have to have the EIN number, okay? And then down here at the bottom is our little due diligence on this form. Again, we talked about the 8867. We'll also have that on there. But we have this one down here. Here's our due diligence. Has this been claimed for any student for 4 tax years before 16? We have a yes and no, and it tells us what we should do. When it says yes, stop, that means we can't do the American Opportunity. We go to line 31 of this form, and that's where we could qualify them for the lifetime learning because there's no year limitation. Okay? Second one talks about being a half-time student. Again, that depends on the university and what they consider a full-time student. The box will be checked on the 1098-T. All right. Did the student complete the first 4 years of post-secondary? Okay. Again, we can check and see on that. You know, have they been in school for 4 years? Okay. And then we talked about the one with the possession or distribution of the controlled substance. Okay. All right. And again, you can see where the form flows over. Okay. This is a great image here where it shows both the refundable and non-refundable. Okay. All right. We can see with the credits up here. All right. In this section, we have it up here with the refundable credits, or excuse me, non-refundable credits. We've had a calculation of our tax on line 44, and we can see that the $1,500 ate up part of our tax bill. So we've used up to $1,500 already. All right. Now, if we go down a little bit farther, we can see the refundable portion of the American Opportunity Credit on line 68. There's the other 1,000. So in the non-refundable portion up there eating up the tax bill, we're never going to use more than the 1,500. That way everybody's guaranteed to get 1,000. So you can see as to why this is a very beneficial tax credit. Okay. Lifetime learning credit, again, big thing to remember, we're not going to go through a lot of stuff here, but the big thing to remember is it is eligible for all students, all right? But it is a credit of $2,000 for qualified education expenses for all eligible students who qualify. $2,000 limit per tax return, so you can never get more than $2,000, okay? A lot of the same rules, but as we talked about at the outset, you know, qualified education expenses are the same. Where that money comes from is the same. You could do one course. So if you're working and you're taking one course a semester to get your MBA or whatever, your master's in something, teachers going back to school for masters, even one course will qualify for you. No, just no restrictions as far as the felony drug or anything on that. Comes down on the same 1098T, so we'll see it the same. Like I said, a lot of times with the one for the lifetime learning, we're going to see down in box 9 that it is for graduate school. Okay. Here's an example again of a 1098T. All right. And again, the formula here, the sheet that we're talking about, in this case, we had yes. So when we go down to our form, this one flowed to the lifetime learning. We did not do the American opportunity. All right. As far as the maximum amount, you can see there on line 27 of this form, you cannot enter more than 4,000. It's a shame. There's not a lot of schools that have tuition that's less than $4,000. So it'd be nice to enter more, but you can only enter 4,000 of qualified education expenses. Okay. So even if you're at a private school and it's $45,000 to go there, you can only enter 4,000 of qualified expenses. Okay. This is going to be a very interesting credit now for people in New York because we now have tuition-free school in New York. Okay. So we want to kind of see what's going on with these. All right. So it may be the case that the Excelsior Scholarship, as they call it, for the tuition-free scholarship for everybody in New York, it may be the case a lot of people will lose this credit, okay, because on this credit, it does not cover room and board. So if somebody has to take out a student loan for room and board, but their tuition is all covered and they don't have a scholarship, they may not be eligible for this credit any longer, okay? So it's going to be very interesting to see how this works out because those credits are only for qualified tuition, all right? Okay, bunch of examples here. Again, you know, I'll be sending those out like I did on the other ones that we want to make sure that you fill out and learn to do these forms. Because a lot of these forms contain things that talks about the maximum amount that you can take, okay? It also talks about things that disallow you, just some of the things that we talked about in the text, but you see it in action on the actual forms, okay? All right. Okay. And again, this last little section talks about scholarships, fellowships, grants, different things like that. That you know, we have and that we have to report those. Again, right here it talks about Form W-2, okay? And it may be on line 7 as a scholarship, or it may be just something that we have to put on that line to say that we had income, okay? All right. What we're going to do right now is we're going to take about a 5-minute break, and then we'll come back and do some problems, okay? So we're going to stop for just a few minutes. Looking around the problem, we have all right, we have their date of births. Lisa, May 20th of 68. Jeffrey is employed in business administration. And we have Lisa is a homemaker. Okay. As we talked about, married filing joint. As we heard in the bullet points, they have some kids. They have Christopher. All right. Chris. His date of birth. All right. We have his social security number. And we're talking about all those things that we've talked about residency and things for earned income credit, refundable versus non-refundable credits. This is the one I think Chris that is with us had asked. This column right here, all right, the one that you see here with the EICs and stuff like that. This is one where that is determined whether they're eligible or not. We talked about each one of the criteria that you have to have for that earned income credit. For that earned income credit, I'd like everybody to be in the habit of just checking that box. Even if it's checked and they're not eligible, it's not going to hurt the return or have the return rejected in any manner. So just make sure that you get used to checking that. Remember, the other one that we have on there is if they have dependent care expenses. Okay. For this problem, we didn't have anything in the bullets. We don't have any tax documents for any of the kids. So that DC one that's next to it, we don't have to check. Okay. And then we have their daughter, Lauren. Okay. All right. And she, again, another child who lived with them. All right. Again, get in the habit of checking that. Remember, yellow boxes, those cannot be checked. If I try to check the yellow box over here and put something in that, it says that it's calculated entry, it's not going to let me do it. Okay. That's only going to be given if their age meets it for the child tax credit. Okay. We have the birthday here. Okay. All right, another son that they have that lived with them all 12 months. Okay. And again, because we have the two kids that have not reached the age of 17, we have some child tax credit. They're New York residents all year long. They'd like to e-file. As we said in there, that they're going to have their money deposited should there be a refund into the okay. We have that. PIN numbers, like I said, usually has to be 5 digits. I just use their zip code. Today's date. Okay. All right. When we get into the offices or you're doing tax returns, you can worry about the driver's license. And again, probably notice that now once you've put your preparer ID, your initials in there, that it just kind of fills everything else in there. Okay. All right. First thing we're going to cover, again, when we talk about the return, I like everybody to use the tree on the left. We get those little blue check marks that we know that we've completed that form or that it does not need us to have any more information. So we get those red exclamation points, and that's where we got something we got to finish up. Okay. In this case, we have the box in the middle of the 1040 page 1 that says, did you itemize deductions last year? Okay. Well, we know that Jeff and Lisa from our bullet points on page 58 did do a 1040, so that tells us that they were itemizing. So we're going to check yes. Now, this is where I said I come back to this. If you look here, our box turned red. That means we have to claim, if we itemize, we have to claim our refunds. All right. There is a worksheet, but it's something that really isn't beneficial unless you have history for somebody. But in this case, we have $1,066 from the refund. But as I said, they had the Empire State Child Credit of $660 that they received. Okay. What you can do is for the amount of the refund that you have to claim, you take and again, this little function key, you hit F5, it pops up a calculator. But we have the 1,066, and we get to subtract the 660 from there, okay? So when we do that, we have the $406 is all of the refund that we have to claim. Okay? All right. Next thing we're going to go to is our tax form. So if we look at pages 60 and 61, first thing we're going to do is we're going to check too that their ACA for their health insurance, their Affordable Care Act worksheet. Again, talked about this. We'll cover it later in chapter 16. I'll have a bunch of knowledge to share with you on it. But for right now, we're just going to check that they all had insurance and for the 12 months, so there's no penalty for not having insurance. And we're going to check that we don't have to worry about the forms 8962 or 8965 right now. Okay? So first thing that's going to go in, W-2. We have Jeffrey working at All Business. So you can get the W-2 by going to the tree on the left. You can see where it's blue here. We're going to check taxpayer. As I've told you, always make sure that the address that you have on the screen matches the one on the paper, so we can check that that was the case. We're going to put in his employer's EIN number. And most of the time the database will automatically fill this in, but because we're in the student mode here, we have to type each one of these in. So he works for All Business Solutions, and their address is 246 Delaware Avenue. And on this one, we can see that he had wages of $83,551. Okay, keep that number kind of in the back of your mind, because remember we've talked about phase out, so we may have to come back to that. On this one, if you look at box 14 in the W-2 on page 61, we have New York State Disability, so we can override the 414 or the state pension that's there. You can put in a $31.20 for New York State Disability Insurance. Again, sometimes out of sight, out of mind, make sure you go down to the bottom, get that information for the state withholding. In this case, it's down there. State ID numbers are always going to be the same for New York as far as the federal ID number. So we put that in. And we have our state withholding. Okay, so we have that there. All right. Next thing we're going to do is we're going to go back over on the page 60. We have some interest income that we have there. All right. Remember I've told you interest or unearned interest income. It goes on the B, but it doesn't necessarily go right on the B. So we're going to go to our form, our line 8, where we'll go there. We'll go into and find, hit F9, go into find our Schedule B, which will bring that up. Remember, Part 1 has interest, Part 2 has dividends. In this case, we have a 1099 INT for interest income. We're going to go to the small area under other interest with the B. We're going to light that up, hit F9. That allows us to go to our worksheet, our new interest statement. So we can go there. We get a nice little worksheet that looks very similar to what we see on our document there. So in this case, we have Bank of America. We look at box 1, we have $71, but we also have box 3 with some interest on some savings bonds. So we're going to kind of separate this into 2 lines. First one, we're going to do the $71 on the interest. Okay. Second one, we're going to do Bank of America. And we're going to call this one bonds, okay? And in this case, we have $278, nothing else there. But we have to remember, from our studies of unearned income with interest, have to remember that bond interest or U.S. savings bond interest or treasury obligations are not taxable on the state. So we're going to go into the state adjustment for the negative in the plus and minus column, and we're going to take that adjustment off, okay? So we've taken that off there so that we know that it's not going to be taxed on the state side. All right. Now, next part we're going to go to tuition. Okay. Remember we talked about the fact that the tuition appears on the credits. Okay. You can see here the non-refundable credits. I talked about line 50 in the text. We're going to go to that. And we're going to go to the F9 because we see that there's an 8863 here. Okay. Now, a couple things. We really have two tuition things to talk about. This one is for their son Christopher, attending Canisius College. Okay. So we have that. But the other thing that was in there was in our bullet points. It says that Dad took 3 graduate classes at the university for $5,500, but the tuition was paid by his employer. Okay, what that means is he doesn't have any qualified education expenses even for the lifetime learning credit because he did not pay the tuition. It was not in the form of a loan or money out of his pocket. It was paid by his employer. So there's no claim for that. So that actually does not go on the tax return. Okay. It probably is going to show up, it's not taxable income. And if it is, it will be on his W-2 from his employer. Okay, because they reimbursed him for that. So that's nothing we have to do like a scholarship would be to go on line 7 as taxable income. All right, so we are at Christopher. So again, to validate that the claim we're making here is for somebody that is a dependent on the return, we have to put the name in. We have to put the social in. Okay, this was Canisius College. All right. We have some questions that lit up here for us. It's asking, do we have a 1098-T? We do. Page 60, we have that, so we're pulling that information there. It's asking, did the student receive a 1098-T for this institution in 2015 with box 2 filled in and box 7 checked? What that means is that did the previous year's 1098-T have the spring semester rolled into it that we talked about earlier? Okay, in this case we're going to say yes. Okay, it doesn't affect what we're doing here. It's just a way for them to double check. All right, and in this case we have Canisius's EIN number that we have to put on there because that EIN number may identify them as a qualified educational institution to be able to take the credit. All right, in our bullet points it said Christopher is in his first 4 years. Okay, so he has not claimed all 4 years. He was at least a half-time student. We look at box 8 of the 1098-T on page 60. You can see that that box is checked. He has not completed his first 4 years of post-secondary education. And as it said in the bullet, he was not convicted for any for any felony or possession of any controlled substances. Okay. Once we've done that, we now have 2 boxes light up at the bottom. One under the section for the American Opportunity Credit, the other for the Lifetime Learning Credit. Okay, you can only enter the amount in one. Now, as we talked about, we look at box 1, we got $17,555 of tuition paid, and then we have a $10,000 scholarship. Okay, so we have to subtract box 5 from box 1, giving us $7,555. But as the form says, we cannot enter more than 4,000. Okay, so we can only put 4,000 in there because that is where the maximum credit of $2,500 is calculated. Okay, so we have everything in there now. We're going to go back and clean up a little bit that we have on there. If we look, the one thing that remains is the 8867. We talked about this in our refundable credit chapter because it's our due diligence that we must do in order to validate everything that is on the return. A couple things that are in play here, if we look at the red boxes asking for information, the child tax credit and the American Opportunity Credit. Okay, our first question, did you complete this based on all the information that was provided and reasonably obtained by you? Basically, it's asking, did you ask the right questions? Okay, it's asking, to meet this, did you interview the taxpayer, ask the adequate questions, and get the documents? Okay, we're going to say yes on both of those because we received those for the taxpayer. All right. And was it reasonable information? Yes. Okay. This one, did any information provided by the taxpayer, a third party, or reasonably known to you in connection with preparing the return appear to be incorrect? Again, I used my instance of the young lady with her friend sitting in the chair, gave me information that said that she should not be eligible for this credit. Okay, so we're going to have this. All right. This one, as I talked about when we looked at the text, this is where we would show that they had any information. You know, and if it's a case that the 1098-T is not able to be produced, this is the perfect spot to type into this, and we'd be able to type into the field here. We could do statement of student account from college, okay? Saying that we got something that was extra that we have, okay? That shows us what those are, all right? Did you ask the taxpayer whether he or she could provide documentation? Again, a lot of redundancy here, but it's our due diligence to prevent us from those penalties, both financially and criminal, okay? And we have these. All right, so we got our blue check mark. There's a page 2 for this form, our due diligence form 8867. This is just for the child tax credit. Again, it's asking, does the child reside with the taxpayer who's claiming the credit? That's one of our tests, okay? Have you determined that the taxpayer has not released the claim to another person? We talked about that with claiming. We'll get into that a little later again. And this one is about due diligence for the American Opportunity. Did the taxpayer substantiate or form 1098-T and receipts for qualified tuition? Again, that receipt might be that statement of student account or something from the bookstore, okay? And then asking again, did you certify all the answers on this form? Asking you, did you ask them once, not once, but twice, okay? So we have all that information there, all right? So we completed that. Now, we're going to go over to New York and talk a little bit about some of the considerations that come into play here, all right? From our information that was in the information sheet in the text or the workbook on page 59, we have Erie County. We have Alden as far as the schools, okay? Don't worry about looking up the school district number, but yeah, we will. We'll take it. We do, while we're in there, we hit F1. And remember, that takes us to that little sheet that helps us find the school codes, okay? And we have Alden's school code, all right? So we have that as 007. And they're not hiding any money in the Cayman Islands or any other foreign country. Now, if we look down below here, we got this New York 272. This is the college tuition credit that shows up. It asks us if we did the college education or the 8863 credit form on the federal. It then asks us, is the student a dependent? Yes, he's been claimed as a dependent. Again, undergraduate, so this credit being refundable is asking if it's undergraduate. Now, as far as the amount, this one is not restricted to $4,000. So if you remember on our 1098-T on page 60, we had $17,555 less the scholarship. So we can put that full amount in here. It's not capped at anything, okay? Now, on the second page of this form, so if you go to your tree and go to New York 272, page 2, on the second page here, the bottom, there's a box. If we check the first box, our tuition is going to be handled as an itemized deduction. Well, if we did that, it shows that we'd owe $57. If we decide to take it as a credit, it shows we get a refund of $245. This kind of goes back to what we talked about at the beginning of chapter 6, when you take things of credits versus deductions. Sometimes a deduction, dollar for dollar, being reducing your income. In this case, they don't itemize enough on the state side. So the credit, being dollar for dollar off their tax bill, is a much better situation for them. Okay? So if we go to page 4 here of the New York 201, you can see that college credit. They have a tax bill, they have the kids, family relief credit, and the New York State tax withheld from their pay. So that being greater than their tax bill, they have a refund. Okay? So everything is completed on that one. We have all their education credits and everything that is on that one. All right. Any questions from anybody on that one? Problem 5.1 for the Harmons. Okay. All right. We're going to go through one more problem here. We are going to do okay. We're going to go to chapter 6. We're going to go to page 71. We're going to do Nancy Reader. Looks like she's single, so we're going to do Nancy. We're going to close that return. Going to start a new one here. We're going to get her information in there as far as her. I went ahead and did this one ahead of time here. Okay. So we have this one with Nancy Reader. We got all of her information in. So you can see that we did all of her information. She's a cashier. All right. She is a single parent with 3 kids. Okay. If we look at the dependents, they meet the age qualifications. So she's able, with qualifying child, to file as head of household. All right. We have her bank information in there. She filed in the bullet points. She filed last year on a 1040A, which says that she does not itemize her deductions. Okay. So when we go to 1040 page 1, you can see down here, she did not itemize. Okay, so we check no, so we don't have to claim any state refund. All right. One of the next bullet points that was there on her just talked about that she's not a full-time student, no EIC disallowed, and again, the entire family had insurance. All right. Now, on this one, okay, we have her W-2. She works at Pizza on the Corner as a cashier. We have her income. We checked her address. All right. Everything's gone in there. We have the wages, her withholding. Down at the bottom, we have her state withholding. Okay. So we have everything there. All right. Now, that is in there. If we take a look on the main info sheet, we discovered that Mother's Helper for the younger kids that were in there for Mary and Sam, they're actually at Mother's Helper daycare. Must be an after-school program so that she can work, and that they on Main Street. So the 2 of them, she had $1,700. Well, we can see here in our BC column for dependent care, we check those. That resulted in a 2441 being on our tree on the left. We type in Mother's Helper, Main Street. Again, this is a situation. This is somebody that's licensed as a business, so they're going to be claiming this as income for us to be in expenses. Pizza on the Corner did not have anything in box 10, so she has no reimbursements from any employers. So we put the $1,700. That's total what she paid. As you can see down here on the form below, you can see that there is a spot that we put in Mary and Samuel. They're on there, and they have expenses. You can see on that statement, whether it just be the small one, that have $1,200 and $500 for each of them. Okay. All right, so we have that. Okay, so we put that in there. If you look down here, it's a little bit better calculation. You can see all the different things. Because of where her income is above that 43,000, she's only going to get 20%. You can again see the 1,700. She's eligible for $340. Okay, the 20% of the 1,700. You can see her tax liability so that they know that she's going to get that credit. All right, so she's going to get part of that credit to help her with that. All right. And if we take a look at the 1040 page 2, we can see there's $340 of refundable, or excuse me, non-refundable credits that have come over. We have the child tax credit. This is a prime situation where it shows typically we would have 3 kids eligible for the child tax credit. So with all 3, we should have $3,000. Well, we used all of our child credit. We have our, dependent care credit. We have all the child tax credit, but we didn't need all 3,000 because it got us to 0. All right. So down here at the bottom, we have the additional child tax credit, a refundable credit. All right. Her income was too high with 3 kids for the earned income credit, but she didn't lose out on that child tax credit. So basically, everything that was withheld from her paychecks, the $3,254 that was withheld, she gets that all back. Okay. So if we take a look here, she gets all of that back. All right. Plus, she gets the excess of what we wouldn't have left on the table of the $3,000 for the kids in the form of $4,400 for the child tax credit. Okay, so she has all of that there. All right. Now, as I said, that the state side there, or excuse me, on the federal side, the child tax credit is a non-refundable, so it's just a Pac-Man credit that eats up our credit on there. But you also get the claim for the child tax credit on the state side. If we look at the New York page 4, we can see that there's another $340 there that we get as a refundable credit. Okay, so she has that, the kids. One thing I will point out about the Empire State Child Credit, in the eyes of New York, your child does not exist until their 4th birthday. For the first 3 years, they are not a child credit. They say in New York that you don't get a credit for them until they turn 4. Okay. We have our family relief, our withholding. So obviously, what we paid in and what credits we received is greater than our tax. So we have the amount here as far as our refund. So there's the refunds on the 2 of those. Okay. So that's one that's kind of showing you how those refundable and non-refundable credits work on the 2 there. Okay. All right. So there's a couple problems. Covered a lot of material. Again, I'm going to have some lectures that will be going up. This one will be recorded that we already did, and it will be going up on the YouTube channel. I'll be sending the link to everybody, as well as the ones from the class. I do some other problems there. I try to mix them up between the 2 so you can see plenty of problems. Tomorrow I'll be sending out PDFs of all the returns that we've done to date, so you can see those. But at this point, do we have any questions? Anybody have any questions? Okay. Any of the students from Florida, I sent out an email, my Florida students, just a reminder that you're lucky enough that you're going to have Esther at the office every other Wednesday from 1 to 3 in Naples, while she's still down there before the tax season, enjoying the warm weather. But she will be there to help you from 1 to 3. So make sure you take advantage of that. Okay? All right. Any questions from anybody at this point? If there's no questions, and again, email those to me. Send the questions that you have. Most of them I'll collect and try to cover for the group, because sometimes I'll get a question that I know is pertaining to everybody, and I'll answer those during the lecture time. But if it's specific to things, we'll get back to you on those, okay? All right. Everybody enjoy the rest of the day. I'm in Buffalo, or excuse me, I'm in Cleveland, as I said. Right now it's about 34 degrees, and we have a little bit of snow, so I guess that time of year is here for us. So those of you in North Carolina, Texas, anywhere else, Florida, send some warm weather our way. Everybody enjoy the rest of their day. Thank you.